It's Henry from Investment for Expats, and I'm going to go over the markets in 3 minutes. It's been a big week for markets. We've had the tech earnings, we've had the UK budget, we've had the Japan yen weakening, and we've got the election around the corner. In the US, we had the big tech report their quarterly earnings. It was a mixed bag. Google increased its share price, as did Amazon. Google was on AI spending. Amazon was on good cloud data. Microsoft came in a bit below analyst expectations. Apple showed weak sales in China, which is nothing new. And Meta said it's going to increase AI spending that worried investors. My thought on this is that big tech is a place you want to be. They've just got big moats around them. I think they're great companies, a lot of them. They've got good earnings. They've got good earning potentials. The problem with them right now is that they're just priced to perfection. As you saw with Google or Microsoft, when they come in near analyst estimates or even just slightly below analyst estimates, the share price drops quite significantly. How I would play this is, if you've got a portfolio and you've done well in tech, I would sell a bit out, maybe put in some money markets and then look at buying the dip again. I think you will have a dip, whether it be from the macro or the micro on these techs, and look at getting in then. I think it's just priced, they're just priced too well at the moment, but the long-term narrative stays the same and would want to be holding these companies long-term. If we go to the UK budget, now the UK budget saw, as expected, increase in taxation. It was quite punitive in a lot of ways. Capital gains tax has gone up to 24% at the top rate. The bottom rate's gone up as well. You've had a number of strategies increasing pension into the inheritance tax estate. What I think from a macro perspective is that you're going to see more people leaving the UK, high earners. I'm not too bullish about small cap UK companies. I think they lack innovation. They don't have much drive out there, and the taxation isn't there. That's why I'd stay away from smaller cap. The FTSE 100 is a different story on that. I'll play that for the dividend. Next up is the Japanese yen. The yen has been weak all year. It's tried a number of job earning techniques. It's also increased its interest rate. I think Japan's something that I'm not long against anything, but probably the Japanese yen dollar cross. Japanese assets, I think they've got some growth, but won't want to stay there. In terms of the election coming next week, I see it as a coin toss. Don't know where it's going to go. Maybe brace on the sidelines, stay in money markets, and look to buy the dip on that.